afternoon, everyone. Welcome back to my channel. So, on today's lesson, which is lesson 6, and if you have been following, you know that we are in the 6th lesson in stock basics. So, this is what we have today. What you should understand after this lesson is that by the end of this lesson, you should understand the difference between private and public company, why companies sell shares to the public, what an IPO is, what happens during an IPO, what the stock exchange does, the difference between the primary and the secondary market, private company versus public company. Let's start with a simple example. Imagine you start a company called ABC Food Limited. You own 100% of that company. As the business grows, you need 500 million to build factories and expand. You have two major choices. Option A, borrow the money. Option B, sell part of the company to investors. If you sell part of the ownership of the company to investors, you are selling shares, but there is an important distinction. A private company doesn't have its shares freely traded by the general public on a stock exchange. A public listed company, on the other hand, has shares that can be bought and sold by public investors through the stock market. 2. Why would a company want to go public? The biggest reason is raising capital. Imagine ABC Food needs 10 billion naira to expand across Nigeria. Instead of taking 10 billion naira loan, the company could sell shares to investors. For example, the company could issue 1 billion new shares at 10 naira each. That would raise 1 billion times 10, and that would be equals to 10 billion naira. The company can then use the money to expand its business. Other reasons company go public. Number one reason is that they want to raise money for expansion. They want to build new factories. They want to also acquire other companies, pay down debt, increase public awareness, give existing shareholders an opportunity to sell some shares, improve access to future capital. Number 3, what is an IPO? IPO means initial public offering. It is a process through which a private company offers its shares to the public for the first time and becomes publicly traded or listed. Think of it this way: private company, IPO to public listed company. Example, before an IPO, ABC Food is privately owned. After an IPO, ABC Food offers shares to public investors and becomes listed on the stock exchange. Now, ordinary investors can potentially buy its shares through their brokers. What actually happens during an IPO? Let's use ABC Food for example. Step 1. The company decides to raise money. ABC Food wants 10 billion naira to expand. Step 2. Professionals help prepare the company. The company works with financial advisors, lawyers, auditors, and other professionals to prepare the necessary documentation and financial information. Step 3. The company determines the offering. The company decides how many shares it wants to offer and terms under which investors can buy them. Step 4. Investors are given information. Potential investors receive information about the company, including its business, financial position, risks, and terms of the offering. Step 5. Investors buy the shares. Investors who participate in the offering provide money in exchange for shares. Step 6. The company becomes listed. Once the company process is completed, the company shares can begin trading on the relevant stock exchange. Number 5. What is a stock exchange? A stock exchange is an organized marketplace where securities such as shares can be traded under established rules. For example, in Nigeria, the major exchange is the Nigeria Exchange Group. The listed companies and investors don't simply meet physically and exchange certificates. Modern trading is conducted electronically through regulated market infrastructures and brokers. Step 6. Primary market versus secondary market. This is very important. Primary market, this is where securities are issued to investors for the first time. For example, ABC Food issues new shares and investors buy them. The money goes to the company. Think investor to company. The company receives capital. Secondary market. After the shares have been issued or listed, investors can trade them with one another. For example, you own 1000 ABC Food shares. Another investor wants to buy them from you. You sell your shares to that investor. Money goes to you, not the company. Just think about it this way: investor to investor. That's where much of the everyday stock market trading you see take place. 7. An important point about stock prices. Suppose ABC Food originally sold shares at 10 naira per share. After listing, investors become very optimistic. More people want to buy the shares. The price might rise to 15 naira, 20 naira, or even 25 naira. The company doesn't automatically receive those extra 5 naira or 10 naira or 15 naira. When investors trade its shares in the secondary market, those price movements primarily affect the market value of the shares held by the shareholders. Simple example, imagine ABC Food has 1 billion shares. The company initially sells 100 million new shares at 10 naira. It raises 100 million times 10 naira equals 1 billion. Now suppose the shares later traded at 20 naira. The company has not suddenly received another 10 billion naira simply because the market price increased. Instead, the market is now valuing the shares at a higher price. This is one reason you need to understand the difference between raising capital and trading existing shares. This is for today's lesson. Now you understand how companies go from being private to becoming publicly listed, what an IPO means, and the difference between the primary and the secondary market. If you found this lesson helpful, follow the page so you don't miss out the next lesson. We are building your stock market knowledge step by step from beginner to advanced. See you in the next lesson.